Netflix Inc. is currently trading at $722.57 a share. Earnings are around the corner on the 17th of October, and what we're going to be doing is seeing if it is a buy before the earnings release. What we're going to be doing is looking at my automated stock valuation spreadsheet to look at the latest company financials, then give a fair value based on the discounted free cash flow model, comparable company model, and of course the Ben Graham formula for intrinsic value. So, as I said, Netflix earnings is around the corner on October the 17th, but this stock has been on tear the last year, up 54% year to date, and even up 87% in the last year. If we take this out of the 5-year chart, this stock was previously trading at $690 a share, had a massive 72% decrease to 187, and has been up about 300% since then to its all-time highs. So let's have a look at my automated stock valuation spreadsheet. If we put in the ticker Netflix, which is NFLX, NFLX, what this will do is it will load all the latest company financial data, and then we can have a deeper look. So market price of $722, market cap of $310 billion, PE ratio a little high, 45.16, market is around about 30, earnings per share of $16 a share, beta of 1.26, meaning it's slightly more volatile than the market, and analysts are currently saying the target price is about $707 a share, so quite interesting. So let's have a look at the revenue. Revenue is at all-time highs, $36.3 billion. And as you can see here, this is going back to 2009. Revenue has been consistently growing, and this trailing 12 months is no exception. Net income, what they've been doing with that revenue, well, in terms of profit, it is all-time highs again, $7.09 billion, beating all the prior years. Now, yes, there was a down turn in 2022 after a big uptick in profit after the pandemic, but they have gone from strength to strength with 7.9 billion. Free cash flow, this is cash operating activities minus capex, and currently Netflix is generating a lot of free cash flow, not at all-time highs, 6.93 billion in 2023, 6.82 in the trailing 12 months. Now actually what I want to do here is look at the operating cash flow and capex, just to kind of see a bigger breakdown to see if they spend a lot on capex. And as you can see here, capital expenditure is pretty consistent. So operating cash flow hasn't really increased in the last 12 months, so that's a bit of a negative. Shares outstanding, there were some stock splits back in 2014-15, and they have slightly issued some more shares. You can see here 0.43 to 0.45, but they have actually bought some back in 2023, so that is good to see. Now let's have a look at my discounted free cash flow model. This is a way of valuing companies based on their future free cash flows and discounting them to today's value. So as we've seen here, we do have positive free cash flow, minus 14%, $14 a share. I don't think it likes that. In terms of revenue growth, about 7% is being consistent. Those net income margins, I'm going to put that a little bit higher. Now the average is because of their negative free cash flow, but if we go off the current year, and let's assume that they're projecting that forward, $300 a share. So not pretty overvalued in terms of discounted free cash flow model, but that is not surprising. Now let's just see if analysts are kind of agreeing in terms of the revenue growth. They're expecting around 26% of growth over the next 5 years each year. And in terms of revenue, 38 and 43 billion. So we are at a little bit on the lower side. We'll even go about 9%. Still puts it at $300 a share. So discounted free cash flow doesn't particularly like this stock. I'll quickly jump into the Ben Graham formula for intrinsic value. This looks at earnings per share, the PE of a non-growth company divided by the corporate bond yield or AAA bond yield here. So currently this is 4.68. And I believe we said it was around about 25% growth for Netflix over the next 5 years. Puts it about $500 a share in terms of what Ben Graham would say. Now, if this was up to 40%, then it would be a buy. But currently with about 25, not a buy in his eyes. Finally, but the one I like looking at the most is the comparable company model. This is a way of valuing companies, looking at similar companies of similar metrics, similar industries and size. So we'll do 2 ways here. Firstly, we're going to look at fan companies. Actually, no, sorry, we'll do it the other way. These are fellow entertainment companies, so Disney, Spot, and TKO as well. I'll go with them. All similar now. Not really a like-for-like comparison of Netflix for any of these, except maybe Spotify, obviously more music-based. But yeah, Amazon Prime isn't its own thing. So what this will is it'll load all the latest company financials for all these other companies, and then we'll have a look at certain metrics and see if we can. Now, unfortunately, some of these don't exist because we don't have the 5-year growth rates for Walt Disney or TKO. TKO is also not profitable, so it doesn't have a PE, but what we're looking at is profit margins, price to sales, price to book, net income, EV to revenue, EV to EBITDA, PE, and also I've added forward PE in as well. So if we have a look at this, you can see Netflix highest profit margins of all three by quite a bit. Not the highest revenue growth, but price to earnings, which is Peter Lynch's metric, 1.6 compared to Walt Disney's 0.3. If we look at the averages here, EV to EBITDA, looking the highest out of all four, that would put it about $800 a share. Forward PE, now Walt Disney isn't returning that number for some reason. That's a bit annoying. But that puts it at 460 and a implied of about 400 on the EV to revenue. So pretty all over the place, but you can see in terms of the metrics, forward PE, it is lower than all of those and has a good revenue growth. Now for the other one I wanted to look at was on the FANG side. We can't add all of these, but if I was to add Meta, Apple, and Google, which of course is Google, Alphabet, let's see how these companies look in terms of comparisons. And now it will load up all the company financial data for these companies, and we can have another look. Enterprise value, Netflix is the smallest, 316 compared to these $1 trillion companies. Good revenue growth rate, only Meta is higher. Profit margins, yes, it is the bottom, but upwards of 20%. Price to sales, all around 8 and 6. The market average is about 3. These are a lot higher. Price to book as well. Market average is around about 5. These are all higher as well, except Alphabet is probably the closest. PEG, Meta, and Apple are the lowest. Less than 1 is undervalued in terms of Peter Lynch's formula. So Apple a bit overvalued. I should look at Google and Meta again. So now we have, I want to make sure that's getting it right. C5, yeah, okay, maybe they just don't have the P for that one. That's a bit annoying. Oh, wait a minute. A live update. Software doesn't work if you give it the wrong information. Now we have the forward PE. Oh, damn it. Okay, well, at least we have the forward PE now. PE ratio 45, the highest of all of them, so it's not going to like that price. Forward PE as well, a lot lower, 32, but still the highest out of all three of these. So if we were to look at these as sort of the comparable companies, that ranges the price anywhere between 350 and 600. Pretty wide gap, but that gives us an average of 522. So interestingly enough, Netflix not looking like a buy in terms of the models, but earnings will be interesting. Right, guys, thanks for watching. Please give a like on the video, subscribe if you're not already. Check my Patreon as well if you're interested in this sheet, and I'll catch you guys next time.